Thank you. It's a pleasure for me to be here. I'm a big believer in Singapore, and I'm a big believer in ABFER, which I refer to as ABFER, not ABFER. Incidentally, Bernie did start off with my most proud title. I am the second holder of the Bernard T. Rocca Endowed Chair in International Business at the University of California, Berkeley. And the reason I'm proud of this is because there's only been one person who's ever held that chair before. It was the person who hired me, who is now the chair of the Federal Reserve. Janet Yellen was my predecessor, so it's my proudest title, actually. Okay, so Bernie also mentioned the fact that I'm Canadian, which is actually highly relevant for this talk. So let me switch over. Okay, so I'm Canadian, and I'm also the father of a 17-year-old, and those have a lot in common in the following sense. Canadians are used to blaming America for anything bad that happens. Okay, that's a very standard thing. Doesn't matter what. 17-year-olds are always happy to blame someone else for whatever bad that happens to them. And now, as an American, it is the official foreign policy of the United States to blame foreigners for anything bad that happens to us until we make America great again. And that's what I want to talk about. Okay, so in particular, the focus of this talk is going to be on small countries and emerging markets especially. And in particular, whether they have anything to fear from central country monetary and financial policy, okay? And that's been a really popular thing for emerging markets to do recently. Small countries often say, well, the reason why X is happening to us, or capital is flowing the wrong way, or our asset prices are going wild, is because of something happening in Washington, okay? It's because of monetary policy decisions made in the United States that affect our exchange rates, that affect our trade flows, that affect our capital flows. And what I want to do in this talk is debunk that idea. And I'm going to do this in two different ways. I will take both a real approach and a financial approach. Here's the idea of the real approach. Central countries, and when I say center countries, you can really think of the United States, though you can also think of Japan and the Eurozone, but really it's the United States. They engage in unconventional monetary policy. That takes different forms. I'll consider them, but think of the two most important forms of unconventional monetary policy as quantitative easing and negative nominal interest rates. Okay? And it is often alleged by policymakers in emerging markets that part of the motivation for the United States or Japan or whatever to engage in these is to depreciate the exchange rate and to engage in beggar-thy-neighbor policies to raise Japanese or American or Eurozone exports at the expense of emerging markets. Okay? That idea is known as currency wars, and I want to ask the question, is there any evidence of currency wars? That's a reasonably important topic, and it turns out to be one that actually hasn't been addressed quantitatively in the literature. So that's a real approach to asking whether whatever happens in the center leads to spillovers that are negative to developing countries, okay, or is just a scapegoat used by policymakers in emerging markets to blame foreigners for their domestic woes. There's also a financial aspect to this, and so I'm going to be discussing work that I'm doing with Eugenio Cerruti at the IMF and Stein Claessens, who used to be at the Federal Reserve, who's now at the BIS. Now, the idea of this really came from work by Helene Ray. Central countries, think of this as the United States, engage in monetary policy for purely domestic reasons. But that creates spillovers, and Helene Ray has made a very successful career recently out of calling that the global financial cycle, okay? And the idea is that the global financial cycle is created in Washington, but maybe also Tokyo and Frankfurt, and spills over to developing countries in the financial periphery in the form of capital flows, but also asset prices, credit growth, and so forth. Now, one of the conclusions that Helene has come to is that the exchange rate regime has little effect on this global financial cycle, on the consequences of this. And that the only way to protect yourself, if you're an emerging market, is by manipulating your capital controls. I'm not going to worry about that so much. I'm going to ask the question, is there actually any evidence that the global financial cycle is quantitatively important for anything that we care about? And I will deal with the most obvious and important topic today, which is capital flows. Okay? My conclusion from both of these is going to be there's no evidence of successful currency wars that are financial, and there's no evidence that the global financial cycle plays any significant role in affecting emerging markets. Okay, so this in some sense is going to be a negative paper. So the first concern that I want to deal with is the real aspect. Okay, what are the trade effects of unconventional monetary policy in the center? Okay. Now, here are a couple of quotations. I'll only read out one from Ben Bernanke from his Mundell-Fleming lecture in 2015. Currency wars is a colorful synonym for the familiar concept of competitive depreciation of exchange rates, with the goal of diverting world demand toward one's own exports while suppressing imports. Okay, and this is an idea that was probably most vocally voiced for the first time by the Brazilian finance minister in 2010, but it's been stated many times since. Okay, the question is there any quantitative evidence? Now, to the best of my knowledge, and I have looked, there's essentially no evidence that from the literature that there either is or is not evidence that unconventional monetary policy in the center has any substantial effect on either exchange rates or, what I care about, the real consequences in terms of exports and imports for the periphery. Okay, so how do you proceed? How do you think about investigating these? I'm going to make three assumptions to characterize what I consider to be a currency war. The first one is currency wars start with unconventional monetary policy in center countries. Think of this as primarily the United States. I'm not going to restrict myself that way, but that's the easiest way to think about it. The second thing is these are bilateral. Okay? So they involve the economies that are engaged in unconventional monetary policy. Why don't we call those the aggressors, the United States, and those that are not, that are the victims. Okay, so the United States is trying to take advantage of Singapore by engaging in unconventional monetary policy when Singapore is not. And it's clear from the literature, there's a quotation there, that that's exactly what developing country policymakers have in mind. And the third is that if there's a currency war started by the United States, if it's successful, it should raise American exports. So three pretty simple and pretty straightforward characterizations. What does the data look like? So here's an incredibly naive look at the data. And the reason I'm doing this in part is this is, to the very best of my knowledge, the sum of the literature. This is what the literature consists in, looking at graphs in exactly this way. So this is looking at American exports on top and American imports on the bottom, and it's just a time series plot. There are three red vertical lines. Okay? The first one is for the initiation of QE1. Okay, second one for QE2, the third one for QE3. And if you look at them, you'll notice a couple of things. First of all, both exports and imports have pretty similar patterns. They drop, exports and imports both continue to drop after QE1 is initiated. Okay, QE2 seems to make no difference, and after QE3 there's a flattening of both exports and imports. Okay, so from looking at this, you would think, well, it's not obvious that quantitative easing had any effect on exports, certainly not on net exports. But this is, of course, stunningly superficial. Okay? I'm only looking at one country, which is, to the very best of my knowledge, all that's been looked at in the literature. This data that I'm showing you is multilateral. It shows the United States against the rest of the world, but some of America's trading partners, like Japan and the Eurozone, they were engaged in QE as well. And there's no attempt at any cateris paribus. We're not trying to control for anything if we're looking at multilateral data. Okay, so that's clearly unhappy, so we want to correct that. So here's the sort of technically kosher way to do this. I'm going to estimate what is now considered a very plain vanilla gravity model of trade. So the left-hand side is just looking at the natural log of exports. Okay? There are three subscripts because exports are from an exporter I to an importer J at a period of time T. We can basically ignore that, but that's the standard thing. The red coefficient, gamma, is the only thing I care about. That's the effect of unconventional monetary policy okay, that exists in the exporter I, but not in the importer J at time t. And then there are a whole bunch of controls. For those of you who are nerdy, the controls are for each exporter for each period of time, there's a dummy variable. For each importer at each period of time, there's a dummy variable. And for each pair of exporter and importer, there's a dummy variable. So there are like 50,000 dummy variables in here that take care of essentially everything. We don't care about that. All we care about is that gamma coefficient. And again, that's asking the question, if the United States engages in unconventional monetary policy, and I'll talk about what that is shortly, is there an export boost to American exports to countries that didn't engage in unconventional monetary policy? So you expect gamma to be positive. Okay, so if you're a geeky person, you're into this sort of stuff, there's a lot of data here. There are 1.3 million observations, and of course they're all available on my website. To do all the technical stuff appropriately, there are these 50,000 fixed effects, blah, blah, blah. I'm going to skip over this stuff. I'm only going to say this model, the gravity model of trade, let me just go back to it, is one of the most successful models in any branch of economics from an empirical point of view. It works consistently really well. It explains a large fraction of the data in a very sensible way. There's tons of theoretical background for this. It just works really well, which is the reason why it's a convenient tool for estimating the effect of unconventional monetary policy. Okay, a few notes. I am not estimating the effect of quantitative easing on American exports as a whole, okay? That's what is called a monadic effect. That's specific to the United States. That's picked up in a fixed effect. Okay, so that's there in the background. I'm asking the question, is there any additional effect if the United States engages in unconventional monetary policy and Singapore does not? Is there any effect on Americans' exports to Singapore? Okay, so it's the effect of a currency war by a particular belligerent, the United States, on a particular defender, Singapore, after sweeping out the general effect of war on America. Okay, so that's an important thing. How do I measure unconventional monetary policy? Well, quantitative easing, a very easy way to go is a simple dummy variable, which is 1 in any quarter where a central bank engages in balance sheet operations and 0 otherwise. So that's a flow measure. Are they doing something to the flow of balance sheets? There's also a stock measure, which is 1 whenever any central bank has outstanding stocks, unusual stocks of assets. I'm doing that just for robustness. What about negative nominal interest rates? My default is going to be, it's a dummy variable, which is 1 for any quarter where there are negative market interest rates. And as a variant, I use official policy, not market interest rates, all very short term. But this is all very, very conventional and straightforward. For those of you who want to review which are the countries that I'm considering, well, the United States engaged in 3 rounds of QE, and they're listed up there. So did the United Kingdom. Okay. Switzerland has had negative nominal interest rates, so has Denmark. Sweden has both had QE and negative nominal interest rates. Japan has had negative nominal interest rates and 2 rounds of QE, and so has EMU. The EMU, 1 of each. So there are a bunch of countries in the center that have engaged in QE and some that have had negative nominal interest rates. Okay, so what are the results that we see? Well, quantitative easing, turns out, has a small negative effect on exports. So when the United States engages in quantitative easing, but Singapore does not, the United States' exports to Singapore actually fall by about 11%. We'll talk about why. That's statistically significant. It's economically non-trivial. The critical thing is there's no evidence that it's positive, and the idea that it's 0, let alone positive, can be easily rejected. Here's the second result. You get exactly the same thing if you look at countries that have engaged in negative nominal interest rates. Okay? In fact, the size of the effect is basically the same as quantitative easing. And you can almost never reject the hypothesis that the effect of negative nominal interest rates and quantitative easing are the same. So unconventional monetary policy, either way, seems to have a negative effect. Okay, so for those of you who want to actually see what it looks like, focus on the right-hand side column 4. That says, if an exporter engages in quantitative easing, but not the importer, that reduces exports by about 7%. Okay? If the exporter engages in negative nominal interest rates, that lowers the exporter's exports by about 5%. And the hypothesis that the two are the same is easily consistent. Let me just remind you what the 3 or 4 bottom rows indicate. There are tons of fixed effects here, controlling for anything that an exporter is doing in a particular time period, anything that the importer is doing in a particular time period, and any interactions that the exporter and importer have over time. Okay, so the results here in a very straightforward, very standard model are completely inconsistent with the idea that the United States or Japan or the Eurozone launched a currency war and won it. They might have launched it and then just lost it. But there's no evidence that emerging markets have suffered at all, at least in terms of their trade. Now, we'll have some time for Q&A, and let me try and deter some questions, okay? Because I have tons of sensitivity analysis. I hope any reasonable question that you're going to ask me is covered in one of these rows that I'm not going to show you for any length of time, but these results are stunningly insensitive to all sorts of perturbations. Okay, let me summarize. The evidence on the effect of unconventional monetary policies on exports is quite clear. If Japan tried to depreciate the yen by engaging in QQE and raising its exports, it had the exact opposite effect. Countries that use quantitative easing and/or negative nominal interest rates have not experienced export booms. And of course, if you actually think about it, you haven't probably ever heard of that from any financial newspaper because there's no evidence of it. And if they had been successful, you probably would have heard of it. So I hope my result is completely plausible. Now, there's an unanswered question that I'm pursuing in further research, which is why did the exports actually decline? And there's a hypothesis out there that I'll throw out, but that's not what I'm really focused on. What I'm focused on here is there any evidence that developing countries, small countries, suffer when rich central countries engage in quantitative easing or negative nominal interest rates? And the answer is no. Okay, so the next thing that I want to do, and the second of the only 2 parts to this presentation, is what are the financial effects of central country monetary policy on emerging markets because of what's known as the global financial cycle? So most of you are pretty familiar with this. Let me give you a quotation from Helene Ray from her pretty well-known Jackson Hole talk. Risky asset prices around the globe, from stocks to corporate bonds, have a strong common component. And remember that. That's going to be important, commonality. So do capital flows. Global financial cycles are associated with surges and retrenchments in capital flows, booms and busts in asset prices, and crises. The picture emerging is that of a world with powerful global financial cycles characterized by large common movements, and again, that commonality, in asset prices, gross flows, and leverage. The global financial cycle can be related to monetary conditions in the center country, again, the United States, or for those of you who are more politically correct, could be Japan as well, could be the UK, could be the Eurozone, and to changes in risk aversion and uncertainty. Capital flows, especially credit flows, are largely driven by a global factor. So now, there's lots of motivation, but again, what I'm going to be focusing on here is cross-border flows of capital associated with the global financial cycle. And I also want to say, this isn't just Helene Ray's idea. It's also associated with Kristen Forbes and Frank Warnock, Bruno and Shin have it in a big way. Rex Ghosh has work on this. So it's a very standard sort of thing. For those of you who are interested, the IMF's annual research conference this fall is completely dedicated to the global financial cycle. That's the entire topic of the ARC this year. Okay, so the global financial cycle should matter for small countries, especially emerging markets. If the global financial cycle explains most variation in capital flows, as Helene clearly believes, then it's very difficult for policymakers in emerging markets to do much more than insulate their economies with capital controls or macroprudential stuff or whatever. Okay? And you see that very clearly in a relatively recent paper by Helene. She writes, as capital flows respond to U.S. monetary policy, they may not be appropriate for the cyclical conditions of many economies. For some conditions, the global financial cycle can lead to excessive credit growth in boom times and excessive retrenchment in bad times. The global financial cycle can be associated with surges and dryouts in capital flows, booms, busts, et cetera, et cetera. So we care about this if we care about the policymaking decisions of emerging markets. Okay, so if the global financial cycle is important, then policymakers in emerging markets really can blame those bastards in Washington, because all you can do is insulate yourself away from them. But suppose the global financial cycle is not that important. Then the onus of responsibility shifts away from the center countries and back to emerging markets. Okay? And I'm going to assert that it's inappropriate for policymakers in emerging markets to blame America for their domestic woes if American financial shocks just aren't that important. So the question is, are they that important? Okay. So next question, how important is the global financial cycle? Now, if you read the literature, and there's a pretty large literature at this point, it leads you to believe that they are very important. But here's the thing that really struck me, and the reason I've started to work on this stuff. The literature is stunningly informal. It consists basically of looking at plots, okay, really with eyeball econometrics and saying, wow, they're really correlated, and that's it. Okay? So the focus of what I'm going to do now is to try and quantify the importance of the global financial cycle for capital flows. First point, if the global financial cycle is important, it should show up in strong commonality of capital flows. So when Singapore is receiving an inflow of FDI, so should Malaysia, so should Thailand, so should Hong Kong, et cetera, et cetera. So there should be this strong commonality, which means you can measure the global financial cycle, overmeasure it, by simply extracting the commonality from those flows of capital across countries. Okay? So one very easy thing to do is to use a dynamic factor model, estimate the eigenvalues, choose the largest eigenvalue, and extract the most important factor, which explains most of the variation. And I'm going to do that. Okay? So that's a way of measuring the global financial cycle simply from capital flows. Okay? It's imperfect because it's going to overestimate the importance of global financial shocks, but that's okay. Second thing, you can measure the global financial cycle via observable fundamentals. Now, there's a very strong consensus here. In the literature, everyone uses the VIX. Okay, so the VIX, the short-term volatility of the S&P 500 traded at the Chicago CBOE. The United States is typically viewed as the center country. I will also look at analogs for the VIX from EMU, from also the UK. There are other measures of uncertainty, and sometimes people say, for instance, that there are other fundamentals that cause the global financial cycle. Okay? So Shin these days looks at the real exchange rate. Some people look at nominal or ex post real interest rates. Some people look at the TED spread, the yield curve spread. I will look at all of these. I will look at 8 different fundamentals measuring the VIX. But just to reinforce, the VIX is the standard way to measure the global financial cycle. Okay, so for instance, there's a quotation, there are a few up there, but let me just do the first one. The VIX is our proxy for the global financial cycle. That's a recent paper by Helene Ray. Large gross cross-border flows are moving in tandem across countries, regardless of the exchange rate regime. They tend to rise in periods of low volatility and risk aversion, decrease in periods of high volatility and risk aversion, as measured by the VIX. It's a very standard thing. Lots of other people use it, and there's some references there. Okay, so first question, what does the VIX look like when you try to correlate it with capital flows? What you see here, why don't you focus on the graph at the top left. On the x-axis for all of these 8 graphs is the VIX, just the level of the VIX. On the y-axis are FDI inflows, foreign direct investment inflows, measured as a proportion of GDP so that we can look across countries reasonably easily. Okay? This is for 63 small countries from 1990 through the end of 2015. Quarterly data, the very standard way to measure capital flows. What you see is essentially no correlation between the VIX and FDI inflows. To the right, you see the same thing for inflows of debt, of bonds, inflows of equity, inflows of bank credit. Underneath, you see outflows. There's just essentially no correlation whatsoever. Now, again, this is super naive. It's just looking at the data. But a naive look at the data means you just wouldn't expect to see anything, okay, in a regression. But again, that's just the VIX and capital flows. What happens if you look at factors extracted from capital flows? Okay, so what you see here, this is a somewhat complicated thing, but not that complicated. The top left, the top left graph and all the columns on the left, that's just referring to the date. And right beneath it is the VIX. So the top left graph that you see here is just a time series graph of the VIX. Underneath it are factors extracted from different types of capital flows. So the third cell down is FDI inflows. So here's the way you do this. You have data for 63 countries: Singapore, Mexico, Peru, Poland, etc. They have data on capital flows over time. And in particular, look at the data on FDI inflows. Poland has some fluctuations. Singapore has some fluctuations. So does Mexico. Extract the biggest common factor, the one that explains most variation. And that's what you see. So over here is what that factor looks like if you just look at a time series plot. Over here is a scatter plot of the VIX against the FDI inflow factor. If those two are strongly related, it should be really strongly positively correlated. Here's the one for inflows of debt. Okay, and again, these things should all be positively correlated if the global financial cycle is driving capital flows everywhere. All the capital flows should have some strong element of commonality. If you look at the data, those scatter plots, for the most part, just look like mush. They're just clouds. There's just no evidence of any strong positive, or for that matter, negative relations. So just again, a naive look at the data, very little evidence of commonality, and very little evidence that the VIX is positively associated with this commonality. But how to do this a little bit more rigorously? Well, here's the way to do it rigorously. The regression is a very straightforward setup. The left-hand side is capital flows, measured as a percentage of GDP, but now there are 4 subscripts, so this is a 4-way panel. D is the direction of capital flows, because capital either flows into a country or out. There are different types of capital flows: FDI, debt, equity, bank loans. Country, I, time T. So you're trying to explain whether, for instance, capital is flowing into Singapore in the form of FDI in a particular period of time. That I'm going to link to. The most important things here are these betas. These betas are looking at US fundamentals. And which fundamentals am I looking at? Well, the 8. The 8 most important ones that are mentioned in the literature. By far the most important one is the VIX. So the first one is the VIX, okay? But then there are a few other ones. There are nominal interest rates, real interest rates, the real effective exchange rate, blah, blah, blah. All the stuff that's been measured in the literature. So that's one way to measure the global financial cycle. But there are other ways too. You can look at commonality. So if I'm looking at capital flows into Singapore in the form of FDI, what I can look at is capital flows into any country, the common element of capital flows into any country in the form of FDI. So that's this dynamic factor over here. So I'm trying to measure the global financial cycle both directly through the VIX and other fundamentals and indirectly through commonality. And I'm just going to say, how well does this equation fit? And I've measured the global financial cycle way too generously here. If this equation fits poorly, I'm going to conclude that the global financial cycle just doesn't explain that much. Okay, so that's the strategy here. Now, there were many equations because There are 2 directions that capital flows. There are 4 different types. There are 63 countries. So I estimate hundreds and hundreds of equations. So all I'm going to do is look at how well a typical one fits. I'm going to show you histograms of the R-squareds, the R-bar squareds, as it turns out. Okay? And here's what they look like. So focus on, why don't we just say this one. This is FDI inflows, okay? And it's the one that performs best. Every single equation that I run for a particular country, like Singapore, okay, there's a time series regression that links FDI inflows into Singapore as a function of these 8 American fundamentals, the global financial cycle, plus these common factors, okay, that say when Singapore is receiving capital inflows, are they going also into Malaysia, into Mexico, into Poland, et cetera? That common factor that's fluctuating up and down. Estimate that for Singapore, get the R bar squared. Estimate it for Mexico, get the R bar squared. Estimate it for Poland, et cetera. So you get dozens and dozens of these. Here's the histogram of what they look like. And what you see is that they typically fit pretty poorly. FDI inflows are the ones that fit best, and the average R bar squared is 25%. Okay? But if you look for many different other measures, they fit even worse. And even then, 25%, given that I'm grossly overestimating it, I'm trying to estimate the global financial cycle in 10 different ways here. That's a pretty poor fit. I have tons of sensitivity analysis. I'm going to intimidate you by showing it to you and then skipping over it, okay? And let me just do one other thing before I conclude, okay? I'm going to say, even though there's no evidence that center country phenomena like the VIX, nominal interest rates, the real effective exchange rate, or commonality in capital flows explain stuff, maybe the global financial cycle occurs only during periods of crisis. Okay? And that's when it's important. During ordinary periods of tranquility, it's unimportant. Okay? So what I'm going to do is I'm going to examine capital flows into a large number of countries, my 63 countries, okay, during periods of crisis. How do I define crisis? High VIX values, which is the standard way to do it. And here's what the event studies look like. So focus on the top left. That looks at FDI inflows for my 63-odd countries. What do capital flows look like when the VIX closes above 30, which happens rarely during this period of time? Okay, this is a standard event study. So 0, the red vertical line, marks the period of time when the VIX closes above 30. To the left, you see the 3 years, the 12 quarters leading up to it. And to the right, you see the 3 years, the 12 quarters afterwards. And there are some confidence intervals around it. What you see is when the VIX rises to above 30, nothing seems to happen to FDI inflows. Okay? But if you look further to the right, you also see for debt inflows, for equity inflows, for credit inflows, again, nothing seems to happen. Same thing for outflows. So really, high periods, the idea of risk on, risk off, it just seems uncorrelated with capital flows to a first approximation. So my conclusion, my summary is, first of all, it's just really hard to see any evidence of a global financial cycle. The VIX and my 7 other fundamentals just don't seem very correlated with capital flows. Capital flows just don't have very limited co-movement. But the more important thing is capital flows are just not driven in the data by center country phenomena, like the VIX, like nominal interest rates, real interest rates, exchange rates, blah, blah, blah. It's very rare for any manifestations of the global financial cycle to explain as much as 25% of the variation. And usually it's much less. So my conclusion is it seems unreasonable for small economies to blame the vagaries of the global financial cycle for their capital flows. Let me conclude. It is easy, okay, to blame someone else for problems that are affecting you. And it's a standard thing in small economies and emerging markets to blame the Fed or more generally northern monetary policies. It's a convenient scapegoat as far as I'm concerned. It's easier to blame outsiders for domestic woes. And just in case you have any doubts about that, the president of the country in which I live is Donald Trump right now. So This has official credibility insofar as he has credibility. My view is that there's little evidence that the woes of emerging markets are due to northern monetary policy. Southern exports tended to grow during periods of time when the North engaged in unconventional monetary policy, either quantitative easing or negative nominal interest rates. So that's on the real side. On the financial side, there's just no evidence that capital flows are much affected by any global financial cycle that exists. Okay, so my conclusion is really the responsibility for any troubles in emerging markets simply don't lie in Washington. Blaming foreigners is just looking for scapegoats. Thank you very much.
So I want to push back a bit on the very last part of your talk, where you drew the focus to crisis periods, which is, I think, probably where it belongs, and broaden your notion of whether the outcome variables of interest are more than just capital flows, because you focused on those and then you kind of extended to a broad conclusion at the end, which is small countries shouldn't blame center countries for their problems. And I recall a plot that Maury Obstfeld showed at the Asian Monetary Policy Forum 3 years ago that captured something that is somewhat at odds with the spirit of your conclusions, and I think I recalled the plot correctly. He showed a picture of what happened to credit spreads in South Korea in the wake of the Lehman Brothers failure. And this was representative of some more general regression results he had. And as I recall, credit spreads widened enormously in South Korea in the immediate wake of the Lehman Brothers failure. Now, that may not involve capital flows. I don't think that was the central focus, at least of what I recall of Maury's talk. But it certainly does seem like an episode in which problems that originated, in that case in the United States, subprime mortgage problems and so on, had global consequences and did, to a large extent, face small countries with problems that were not of their own creation. That seems at odds with the breadth of the conclusion that you drew at the end, and I just wanted to get your reaction to that.
Okay, that's a completely legitimate point. Let me say, I'm focusing here on capital flows just because Bernie wanted me to speak for an hour plus, and I said, here's one thing you've never heard in your life. Wow, that lunchtime speaker didn't go on long enough. Never heard that, right? Think about it, you'll figure it out, okay. So I only focused on capital flows here. So there are other aspects to the effects of the global financial cycle. So one is credit growth, which I've done, I just haven't included it here. And the other one is asset prices, okay? And asset prices, there's almost surely more evidence of it. There's no doubt about that. But whether that's due to the global financial cycle in any persistent way is a very different thing, because it also has, whenever you're testing co-movements of asset prices, you have to have a model of the degree of integration between them. And I'm working on that right now. I don't have confidence about that. I will say the focus here is on the results in terms of quantities. Prices are going to be different. I can't say definitively because I'm doing this work with Stein and Eugenio, and we don't know about that. But that said, unless it shows up in quantities, I'm not sure I'm going to care that much, right? Because prices are, they're great, they're important things, but I care about how they show up in quantities. Okay, Anand.
Yeah, I had two questions. One was, we kind of know in financial markets, downside correlations are higher than upside correlations. So in this context, actually, one would have actually wanted the downside versus upside R-squares. This is kind of well known in financial sort of markets, and I wonder if the same thing applies here. So your R-square is actually underestimating the true R-square. And then the second thing I had was, it's a slightly technical point. We know when we estimate these default kind of regressions, defaults are rather rare events. And so then we always have problems estimating them. In your first model with 50,000 fixed effects, there are essentially only, I guess, 10 QE or 10 how many ever QE observations, and even if you pair them up, 10 multiplied by, and I just wonder if that would actually, yeah, I don't know.
In the interest of time, Andy, may I collect two more questions? Let you handle them all together, and also ask people to maybe keep their questions a bit more concise, please. Shang-Jing?
Yes, well, thank you for a very interesting and stimulating talk, Andy. I want to push back on both parts of your presentation. On the first part, you are testing a version of the spillover or currency war where the other countries do not respond to the central country monetary policy with their own monetary policies. Suppose when U.S. does quantitative easing, other countries have to respond by doing their own quantitative easings in a way that's actually not good for them. So even though their exports may not be negatively affected, their welfare can still be. And you might, your baseline at least testing this, maybe one of your extensions look into this. That's on the first part. On the second part, we think that the properties of capital flows can be modified by ex-ante policy regime choices. In particular, combination of capital flow management policies and nominal exchange rate regime policies could modify properties of capital flows. And the graph and the regression you show do not make that distinction. You look at sort of average capital flow property across all countries. Would it be helpful to also look at whether the capital flow properties are functions of policy regime choices? Thanks.
I should go?
You want to try?
Okay. So I'll try and be brief. Anand made the point that there are only a few incidents of quantitative easing and negative nominal interest rates, and that's right, but that's the data we have. And the question that it strikes me as the one of interest is, for the data that we have, is there any evidence that the emerging markets suffered? And I guess my view is no. Now, Shang-Jin made, apropos of that, the argument that I don't model a response, which is sort of true, but it's not exactly true, because those fixed effects are going to take out anything that, for instance, Singapore did as a response to quantitative easing for any country. So those fixed effects are going to take out anything that's specific to any exporter for any period of time, any importer for any period of time. My whole focus here is only on the bilateral stuff. So I'm not sure there's any evidence of it, but I think insofar as there is, I'm fine because it's swept away by the fixed effects. Shang-Jin also said that I just estimated one equation for everyone, and that's right. But here's where the fact that I did all this sensitivity analysis that I didn't explain helps me, which is I certainly split up the data by, for instance, okay, so you mentioned exchange rate regimes, which are here. The left and right-hand side turns out to show that differences in exchange rate regimes had no effect. Differences in different degrees of capital mobility, whether countries changed their capital mobility or not, whether that affected things or not, that was done in the sensitivity analysis that I just didn't have time to present. And that actually has essentially no effect, no measurable effect.
Professor Rose, in the light of your results, do you believe that carry trade does not exist in international currency markets? Thank you.
So I'm going to pick up both questions and over there, please.
I just wanted to play the role of the typical endogeneity police. So I was wondering whether how to interpret your result of the -7, -11%, because of, obvious concern that you don't have exogenous variation and blah, blah, blah. I'm brief.
Okay, so I can be really brief. Do I think that carry trade does not exist? No, I believe that carry trade exists. It's super risky. We don't really have a good understanding of it from an economic point of view, but from a financial point of view, it certainly seems to exist. Do I think that the 7% is a result of endogeneity? Yeah, I alluded to that, but very, very quickly, but that's part of the story that I'm investigating now. So yeah, I'll agree with you on the blah, blah, blah.